Bitcoin dropped 8.5% the morning the bombs started falling. Every analyst said the same thing. Every headline said the same thing. Every piece of social media said the same thing. Bitcoin is a risk asset. It sells when war comes. This is a fact. But while the price dropped, something quietly happened on the blockchain that is almost never this clear. The amount of Bitcoin sitting on exchanges just hit its lowest level since December 2017. Not a low for this cycle, not a multi-month low, the lowest point in 8.5 years. In the middle of a war, in the middle of extreme fear, in the middle of a 5-month losing streak. Whatever was going to be sold has already been sold. In the next 20-odd minutes, you're going to see the complete picture. Price, on-chain, institutional behavior, the Federal Reserve meeting in 2 days, and one historical parallel from a very specific moment in Bitcoin's past that almost no one is talking about right now. If you leave before we get to the funding rate, you will miss the one metric that ties everything together. Bitcoin is trading at approximately $71,000 as this is recorded. This week's range ran from $64,800 to $74,000. The weekly gain is roughly 8%, and if March closes positive, it will break a 5-month consecutive monthly losing streak, something that has happened only twice in Bitcoin's history since 2018. The 2 previous times were followed by moves of 60% and 95% over the subsequent 5 months. Here's what the noise is saying. Bitcoin is caught between a war and a Fed meeting. Oil is above $100. Dollar strength is back. Wait for the dust to settle before doing anything. That is the consensus. Here is what is actually happening beneath the surface. The exact data profile that preceded every major Bitcoin recovery in this decade is assembling itself in real time. Not all pieces. Not a guarantee. But a pattern that has appeared before, and you're going to see every component of it laid out today. The majority of participants right now believe that because Bitcoin sold off when war broke out, and because fear, oil prices, and dollar strength persist, the path of least resistance is lower. The data disagrees. We are sitting in what cycle analysts call the mid to late drawdown accumulation phase. From the October 2025 all-time high of $126,000, Bitcoin has corrected approximately 44%. Prior cycles produced peak drawdowns of 83% and 77%. The estimate for this cycle is 50% to 60%, reflecting the dampening effect of institutional demand through ETFs. If that compression holds, the mathematical floor sits between $55,000 and $65,000. We are either approaching that zone or have already seen it. There is one metric I want you to hold in your mind right now. The Bitcoin perpetual funding rate. The last time it stayed negative for this many consecutive days was December 2022, the month Bitcoin bottomed at $15,500. In the 8 months that followed, it gained over 200%. The current reading is coming later, and it is worth waiting for. The current market structure on the daily chart is best described as a higher lows compression against a fixed resistance ceiling. Bitcoin's lows since the Iran conflict began have gone from approximately $64,000 to $66,000 to $68,000, forming a stair-step base, while resistance at $73,000 to $74,000 has rejected the price 4 times. That ceiling has absorbed 4 separate attempts. Historically, the 4th or 5th test of a resistance level either sees a clean break or a sharp reversal. One of those outcomes is coming. The support zone that matters most right now is $69,000 to $70,000, a zone that is flipped from resistance to support and aligns with the 20 and 50 exponential moving averages on the 4-hour chart. Below that, $65,000 to $6,500 was the war opening bottom and a zone of serious buyer interest. Below that, $60,000 is the level that would represent roughly a 52% drawdown from the all-time high, still inside the compressed cycle range thesis. On the upside, $73,000 to $74,000 is the immediate ceiling. A sustained break above it with volume likely opens a path toward $80,000, where significant options open interest accumulates and where numerous short liquidations would be triggered, accelerating the move. The daily RSI is sitting in the mid-40s, recovering from oversold territory in the low 30s. The weekly RSI closed at approximately 41, a level that, in prior cycles, has coincided with accumulation phases rather than distribution. The MACD on the daily is in the early stages of a bullish cross. This is not confirmation of a move, it is the precondition. On-chain data shows that exchange net flows have been negative, more Bitcoin leaving exchanges than arriving. Volume on drops has been decreasing, volume on recoveries has been increasing. That is the signature of accumulation, not distribution. The sellers are running out of Bitcoin to sell. Let us separate what is being said publicly from what is being done on-chain, because the gap between those two things this week is one of the most striking on record. Public narrative: Bitcoin is in a bear market. The large corporate accumulator is buying below its average cost, sitting on significant unrealized losses, and analysts question the strategy. What is actually happening? That same company purchased 17,994 Bitcoin on March 9th for $1.28 billion, while Bitcoin was near $68,000. Its total holdings now stand at 738,731 BTC, acquired at an average cost of approximately $75,160 per coin. They are not slowing down. The publicly stated goal is 1 million Bitcoin by the end of 2026. To reach that milestone, they would need to purchase approximately 6,158 BTC per week, a pace they have repeatedly exceeded. Does a company with a 10-year conviction thesis panic at $68,000? The on-chain behavior answers that without requiring any statement. ETF flow data tells a parallel story. After approximately $3.8 billion in net outflows during early 2026, institutional ETFs turned net positive in early March, attracting approximately $568 million in new inflows within days. The largest single fund captured $263 million of that in a short window. Total spot. Bitcoin ETF assets under management sit at approximately $87 billion. On-chain whale wallet data shows the count of addresses holding 1,000 or more Bitcoin has held steady or increased over the past 30 days despite the price decline. The entities capable of moving markets are not selling. The entities making the headlines are not the entities making the moves. Every financial commentator is talking about Bitcoin's bear market. The largest, most sophisticated buyers in the market are treating it as a generational buying window. Those two things cannot both be right indefinitely. The Federal Reserve meets March 17th and 18. The CME FedWatch tool currently prices more than 95% probability of a hold at 3.50% to 3.75%. The rate decision itself is not the trade. What matters is the updated dot plot, the summary of economic projections, and the press conference language. The current median dot shows one 25 basis point cut for 2026. If that shifts to 2 cuts, it is a dovish surprise that lifts risk assets. If it shifts to 0 cuts, it is a sharp repricing that hits them immediately. Historically, in the 2025 cutting cycle, Bitcoin dropped after 7 of 8 FOMC meetings, including meetings where the Fed actually cut. The pattern is sell the news, and it has been remarkably consistent. But here is the macro picture everyone is underweighting. January CPI came in at 2.4% year over year, the lowest reading in over 4 years. The problem is that since that reading was taken, 2 major inflationary shocks have arrived simultaneously. The 15% global tariffs became effective in late February, and the US-Iran war has pushed oil above $100 per barrel. The DXY dollar index broke above 100 this week. Bitcoin outperformed anyway. But if dollar strength holds and energy prices stay elevated heading into the meeting, the dot plot conversation becomes whether this committee is willing to signal any cuts at all in a stagflation scenario. One regulatory signal underneath all of this deserves its own sentence. Kraken became the first cryptocurrency exchange in history to receive a Federal Reserve master account, direct access to the Fed's core payment infrastructure. That happened on March 4th. That is not a speculative development. That is the architecture of the future being installed quietly while everyone is watching oil prices. 6 on-chain metrics. Exact readings. Starting now. The MVRV Z-score currently sits in the 1.2 zone, comparing Bitcoin's market capitalization to its realized capitalization. Readings between 1.0 and 2.0 have corresponded to the late-stage accumulation and early recovery phases of every prior cycle. The current realized price sits near $45,000 to $47,000. Bitcoin is trading at $71,000. The average holder across the entire network is still in profit. The subset currently in loss is concentrated among short-term holders who bought during 2025's rally above $90,000. The STH SOPR reading of 0.97 to 0.99 shows that capitulation is active. Not over, but underway. Exchange reserves have dropped to 5.88% of total supply, a figure not seen since December 2017, which preceded one of the largest Bitcoin rallies in history. Less Bitcoin on exchanges means less immediate sell-side pressure. Demand is increasing. Supply is tightening. Long-term holder supply continues upward on the 30-day trend. Addresses holding Bitcoin for 155 days or more are not selling. They are accumulating, consistent with every prior cycle's accumulation phase. The Puel multiple shows miner revenue relative to its historical average is compressed. Post-halving, new Bitcoin issuance is structurally reduced. Supply pressure from miners is low. And now the 6th metric, the one this channel named at the start and is held until now. The Bitcoin perpetual funding rate has been negative for 14 consecutive days. According to research from K33, every prior streak of this length over the past 7 years coincided with a local price bottom. The traders who are short Bitcoin right now are paying longs to keep their positions open. They are losing money every day they stay short. The longer this continues, the more pressure builds for a short squeeze. The fuel for the next move up is being loaded into the engine in real time. In December 2022, the fear and greed index had been below 20 for over 2 months. Exchange reserves were falling. The MVRV Z-score had dropped below 1.0. Funding rates were negative. The public narrative was that Bitcoin was finished, FTX had collapsed, trust in crypto was destroyed, and mainstream finance had declared the experiment over. Price was $5,500 to $17,000. Within 8 months, Bitcoin was above $30,000. Within 14 months, $43,000. Within 24 months, a new all-time high. Within 28 months, $126,000. The Fear and Greed Index this week is 15 to 18, the exact same range as December 2022. Exchange reserves are at their lowest since December 2017. Funding rates have been negative for 14 consecutive days, the same signal as the December 2022 bottom. The differences are meaningful too. Bitcoin in 2022 had just survived an industry-wide trust collapse. Bitcoin today has 738,000 coins in a single corporate treasury, $87 billion in regulated ETF products, and a cryptocurrency exchange with direct Federal Reserve access. The institutional infrastructure did not exist in 2022. It exists today. The floor, if history rhymes, is structurally higher now than it was then. I'm not saying history repeats. I'm saying the data rhymes. And right now, it is humming a very familiar tune. 3 price levels define the next 30 to 60 days. Level 1, $74,000 to $74,500. This is the ceiling that has rejected Bitcoin 4 times, and where the short squeeze would be triggered. A daily close above $74,500 on volume, exceeding the prior 3-day average, historically adds 15% to 20% within 10 to 14 days. Level 2, $80,000, the level above which Bitcoin would confirm a higher high on the weekly chart, shifting macro structure from bearish to neutral to bullish. Level 3, $65,000, the bear scenario. A surprise hawkish dot plot on Wednesday could test this level. Given the exchange reserve data, a drop there would likely see aggressive accumulation buying. 3 upcoming catalyst dates matter. March 18th, Fed decision at 2 p.m. ET. Historical pattern, Bitcoin drops 3% to 7% in the 48 hours after, then reverses. Patient buyers have historically found better entries, 48 to 72 hours post-announcement. April 10th to 11, next CPI release. If January's 2.4% holds despite oil pressure, the rate cut narrative revives. May 15th, Powell's term expires. Kevin Warsh assumes the chair. The confirmation process between now and then will generate headlines. The single signal that confirms which path wins first, a daily close above $74,500 on volume. Everything else is noise. The single most important takeaway from this week is this. Bitcoin has spent 5 months declining while the infrastructure beneath it has been getting more robust, not less. The on-chain ledger does not have emotions. It does not react to headlines. It just records what is actually happening. While most people this week are watching oil prices, war headlines, and Fed meeting noise, the on-chain data shows that exchange supply is at an 8-year low. Institutional flows have turned positive, and the short seller funding rate has been negative for longer than at any point since the last bear market bottom. One final data point that did not appear anywhere earlier. Bitcoin is currently outperforming every major asset class since the Iran war began. Gold, the S&P 500, Asian equities, all have underperformed Bitcoin over the same 2-week window. Bitcoin was the first market to price the war in because it was the only liquid market open when the bombs fell on a Saturday. It priced it in, and then it recovered. Next week, the Federal Reserve makes its move. Watch the dot plot. Watch the language. Watch the exchange reserves. That is where the story goes next.